Welcome back to the course International Finance. Today we'll be looking at exchange rates and currency markets. By way of module objectives, by the end of this course, students should be able to understand the concepts of exchange rates and their importance in the global economy, trade, and investment. Be able to identify the different types of exchange rate systems in terms of floating, the fixed, the pegged float, used by countries and their impact on the economy. Be able to analyze the factors that influence exchange rates, including economic indicators, interest rates, inflation, political stability, and market sentiment. Students should be able to understand the role of foreign exchange markets in facilitating currency trading and its implication for international business and investment. Students will be able to learn about currency risk and the strategies used to hedge against it, such as forward contract options, and other financial instruments. Students should be able to apply knowledge of exchange rates and currency market to real-world financial scenarios, making informed decisions about investment, trade, and risk management. Introduction to exchange rates and currency markets. In today's interconnected global economy, exchange rates and currency markets play an essential role in shaping international finance and economic policies. Understanding how exchange rates are determined, how currency markets operate, and how currency risk are managed is crucial for businesses, investors, and policy makers alike. Exchange rates, the value of one currency relative to another, influence not only the cost of goods and services traded across borders, but also the ability of businesses to remain competitive in international markets. For instance, when the company's currency appreciates, it makes exports more expensive for foreign buyers, potentially reducing demand for this product. Conversely, a depreciating currency can make export cheaper, but it may also lead to increased import costs, affecting the domestic economy. This module provides a comprehensive examination of exchange rates and the foreign exchange markets. It explores the various types of exchange rates that country uses, the key factors influencing exchange rate fluctuations, and the functioning of the global currency market. Moreover, the module delves into the critical issues of currency risk, which businesses and investors face when dealing with foreign currencies, and it provides strategies for hedging against such risk. The foreign exchange market is the largest, most liquid financial market in the world, with a daily trading volume exceeding $6 trillion. This market is decentralized across various time zones and financial centers, enabling currency transactions 24 hours a day, 5 days a week. Forex markets facilitate the exchange of currencies, impacting everything from global trade and investment flow to central bank policies and macroeconomic stability. A clear understanding of exchange rates and currency markets is essential for businesses and investors engaging in international finance. Whether you are a multinational corporation seeking to hedge currency risk or an individual investor exploring opportunities in foreign exchange market, this knowledge will empower you to navigate the complexities of global finance with confidence and competence. What are types of exchange rate systems? We have the floating exchange rates. This is the value determined by supply and demand, e.g., US dollar and euro. We have two, the fixed exchange rate system. This is pegged to another currency, e.g., the Hong Kong dollar to the USD. We have three, the peg flow system. This is the hybrid system with some flexibility but also intervention, e.g., the Indian rupee. Then lastly, we have the currency board arrangement. The currency directly tied to a foreign currency, e.g., the Bulgarian levy to the euro. These are the three primary exchange rate systems. The fixed, this is where, like I said, it is fixed at a specific value. The floating, this is where market forces of demand and supply affect it. While the peg is fixed to a stable foreign currency or a basket of currency. Then we're looking at some of the advantages and disadvantages of the exchange rate systems. Now, for floating, it allows automatic adjustments, but may cause volatility. For fixed, it provides stability, but requires large foreign reserves. For the pegged floats, it combines flexibility with some stability, but costly interventions may be needed. For the currency board, it offers stability, but restricts monetary policy flexibility. Let's look at some of the factors influencing exchange rates. We have number one, interest rates. High interest rates lead to currency appreciation by attracting foreign capital. Secondly, we have interest rates. Higher inflation leads to a currency depreciation due to reduced purchasing power. We have economic performance. Strong GDP growth and economic performance lead to currency appreciation. Then we have political stability. Stable governments attract foreign investments, leading to currency appreciation. Then we have speculation. Speculation is expectations about future events can drive currency appreciation or depreciation. Like, this is the factors that I just explained here. This is the diagrammatic representation. Let's look at foreign exchange markets. Foreign exchange market, this is the world's largest financial market. Like I said, with daily trading volume of over $6 trillion. The market operates 24 hours a day, 5 days a week across multiple time zones. It includes participants like the central banks, the commercial markets, multinational corporations, hedge funds, and individual traders. Currency pairs are traded and exchange rates fluctuate based on supply and demand. Let's look at currency risk and hedging strategies. What is a transaction risk? This is the risk that arises from the time gap between the agreement and the settlement of a foreign exchange transaction. Let's look at translation risk. This affects companies that need to convert foreign subsidiary financials into domestic currency. What about economic risk? Economic risk, this is long-term effect of exchange rate fluctuations on a company's competitiveness and profitability. Let's look at hedging. What are hedging? Hedges are strategies that include forward contracts, future contracts, currency options, and natural hedging. Now let's look at hedging strategy. The first one, which is what? The forward contract. A forward contract locks in exchange rate for a future date. It is customizable and ideal for businesses with specific foreign exchange needs. E.g., a US company agrees to buy euros at a fixed rate in 6 months. The advantage is that it eliminates uncertainty of exchange rate fluctuations. The disadvantage is no opportunity to benefit if exchange rates move favorably. Let's look at futures and options. The currency futures. This is a standardized contract traded on exchange for future delivery of currency. Currency options. This gives the right, not obligation, to sell or buy currency at a specific price on or before a date. Advantages is that it's flexible and liquid. Disadvantage is that it requires premium payment for options and features are less customizable. By way of introduction, exchange rates and currency markets are integral to the functioning of global finances, influencing everything from trade and investment to policy making and economic stability. Understanding the different types of exchange rates, the factors that influence exchange rates, and the role of Forex is essential for businesses and investors engaged in international finance. Currency risk, while unavoidable, can be managed through effective hedging strategies, helping businesses reduce their exposure to exchange rate fluctuations. By gaining a deep understanding of this concept, businesses and investors make informed decisions that minimize risk and maximize opportunities in the global market space. In the next module, we'll explore international monetary systems, focusing on monetary markets in international finance. That will be all for module 2. At the end of this module, there's an assessment overview where part A is a quiz and part 2 involves a report. I'll see you in module 3.